All right, let's get more now with Mark Keenan, Head of Commodities Research Asia at Société Générale, joins us live here around the desk at the SGX. Mark, is that a fair comment? The spread, if you look at it, has gotten close to $16 a barrel. Some are telling me it could go as high as 20. Is that a bit too aggressive?
It's probably a little bit too aggressive for this time of the year. I mean, it's been building in a near linear trend recently as a function of the rising inventories within the U.S., specifically in Cushing, Oklahoma, that the WTI is very sensitive to. Now, this recent period has been a seasonal slowdown period, but we're now entering into hopefully a more seasonal demand-intensive period, which should stop this trend in inventory declines in the US and possibly bring that spread a little closer together again.
So what that means in practice, Mark, is that the refiners will start processing more crude and draining those inventories. But by the same token, Libya, the unrest and the production outages there haven't gone away. They don't show any signs of going away. Isn't that going to push Brent higher? And the differential will continue to widen.
It could do. I mean, there's nothing really new on the Brent side. The Libyan situation is still very much an issue. We haven't seen any production back on stream at all yet, and we will need really to get that on stream for the demand side of the Brent story as well. But I think the main driver of that Brent-TI spread has been the extreme inventory builds for 7-8 weeks now in a row on the US side. That's been the core driver of the Brent-TI spread.
What's your view on Iran, Mark, and how soon, if the diplomacy continues to make progress, how soon Iranian crude could return to the markets if sanctions are partially dismantled?
Yes, no, that's certainly an area that a lot of the trading community are looking at the moment. And the first thing to bear in mind is that if we could get a deal as early as this week, you know, something positive. But it's important to note that an initial deal with Iran is unlikely to extend anywhere near the core sanctions with reference to the oil price. And it will most likely be a 6-month period where Iran would have to cease any enrichment process. And in return for that, they would possibly have access to some of their foreign reserves that are now around $100 billion offshore, possibly, say, $50 billion, which would be very important for the country. Now, if we fast forward through all that, and let's say we get to a stage when sanctions are lifted and we start to look at the oil situation, the interesting situation is how quickly this oil can be brought back onto the market. And we've been very used to the Iraqi situation where post-sanction period has caused oil to come very slowly back onto the market because these wells were damaged in the war. Now, with Iran, it's a different situation. The wells were shut in a very orderly fashion. There were a lot of reports prior to the sanctions in Iran that these wells were depleting and the yield was declining. So this period where they've been shut has actually acted to stabilize the wells, to increase pressure within the wells. And in the meantime, reports are that Iran has actually been drilling more wells during this period. So it's likely that production could come back on the market very, very quickly.
So it could be quite constructive for the supply picture. Very quickly, Mark, gold. It doesn't seem to have adjusted to this new paradigm, but having said that, some are talking about 1,300 because of Yellonomics. How supportive a factor is she going to be in Fed policy? I
think gold is, a recent price action of gold has shown that it's pretty disinterested at the moment on Fed action, and I think gold is pretty set now to resume its linear downtrend for the rest of the year. We've been through the recent period where we've had the strong Indian buying period. That's had very little effect on the price of gold. In fact, all the physical buying this year, of which the reports have been extensive about, have failed to catalyze any meaningful rally upside. So we still see ETF liquidation. That's happening as we speak. And we're on target. For our initial target was 800 tons for this year. We're around 760 tons. So a little bit more to go. And we see gold down to about another $50 off the gold price, down to around 1,225 for the end of this year.
Mark, I'll have to leave it there, sir. Thank you very much indeed for your time today. Mark Keenan there, Head of Commodities Research for Asia at Société Générale.